Steve from Clearly Training, and you're watching our video from our finance for non-finance people on the balance sheet. So this is video number 3, and this is all about the balance sheet, what goes in the balance sheet, what the different categories of things are that are in the balance sheet, lots of terminology associated with the balance sheet. I'll also be touching on certain things that cross over from the balance sheet to the profit and loss account, and I'll really be focusing on the most important thing, I suppose, in the balance sheet, certainly the most complex, which is the area of fixed assets, or as they're also sometimes called, non-current assets. So let's make a start on the balance sheet. And the first thing that I want to start with is, why is a balance sheet called a balance sheet? What is it about it that balances, and what does it balance from and to? Well, I'm going to give you a little example. I'm going to tell you about a lady called Jemima, and Jemima is an antiques dealer. It's one of her hobbies, and she's decided to turn it into a business, and she's actually set up a limited company, and she's invested some money in that limited company, and she's become a shareholder, and she's an antiques dealer, remember, as a Jemima. And she starts off the business with £10,000, and immediately she buys a lovely, beautiful antique table with that £10,000. So her opening balance sheet, if you look on the left-hand side of the slide there, her opening balance sheet, in her assets, she will have £10,000 worth of assets. She's got no liabilities. She's just started the business. So we'll say her net assets. Net assets is the assets less the liabilities, and net assets are £10,000. And we'll also say she's invested in the business as a shareholder. She's put her money in, her £10,000. So at the bottom of the balance sheet, we will have £10,000 worth of shareholder investment in the business. So we've got two sides of the business. We've got the assets and liabilities at the top, and at the bottom, they balance to the same total as the shareholder's investment. You see, as accountants, we believe that every time a transaction takes place, there will be two impacts, and those impacts will be equal and opposite. And we do that in accounting using our system of what we call double entry bookkeeping. Now, we haven't got 5 days on this video, so I won't be able to go through all of the intricacies of that. I just want to give you a feel for why we call a balance sheet. You can see there, we have a balance. We have one transaction really going on, that money has been put into this business to buy a table, and two impacts. First of all, we've got the table as an asset in the business, but secondly, we've recorded the fact that the shareholders invested £10,000 worth of their money in the business. And you know what happens next? In the first month of trading, Jemima goes and sells that table, and she sells the table for £12,000. So she's actually made a £2,000 profit. She bought it for £10,000. She sells it for £12,000, and it's £12,000 in cash. So at the top of the balance sheet now, instead of having the table there, we'll actually have cash as an asset of £12,000. So swapped a table of 10,000 for cash of 12,000. So at the top, we've got £12,000 of net assets. And at the bottom, we've got the original shareholders' investment of 10, and we've made a £2,000 profit. So we show the profit down there, and that profit belongs to the shareholders as well. So you can see what's going on at the bottom. At the bottom, we're showing what the shareholders' investment is in the business. The shareholders' investment has now gone up to 12,000, which was the original investment of 10, plus the profit that they're entitled to of £2,000. And they can actually take that profit out of the business if they want to. And if they took the £2,000 out, then that profit reserve from the bottom will disappear, but also 2,000 of cash from the top will disappear. So you can see this dual effect thing happening. And believe me, every time we have a transaction, there will be two equal and opposite impacts of that. And therefore, that balance sheet will always be in balance. Now, before we leave this, one final thing on it. You see down the bottom there, we've got this profit of £2,000. And the balance sheet, all it shows you is how much profit you've accumulated over time since the business began, less how much you've paid back to your shareholders. That's all that you see in terms of analysis of the profit in the balance sheet. And that's why when originally organizations started to produce formal sets of accounts. They only produced balance sheets. And then at some point in time, the shareholders of the businesses have said, hey, hang on a sec. All we can see in the balance sheet is that £2,000, the cumulative total of profit we've made so far. What we'd really like to see is some analysis of where that £2,000 came from in each period, how it's changed over each period. And that's why we produce a profit and loss account. We'll be looking in detail at the profit and loss account in the next video, but we produce a profit and loss account so we can give the shareholders an analysis of how the profit changes over the period that we're looking at in the financial statements. Anyway, enough of that. Let's have a bit more of a detailed look at the balance sheet. Remember, the balance sheet is comprised of assets, things we own, and liabilities, things we owe. So really what we're going to concentrate on now is we're going to concentrate on what's at the top of the balance sheet. We're going to look in detail at those assets and liabilities, safe in the knowledge that we know whatever's at the top will always balance to whatever's at the bottom in the shareholders' interest down there. Okay, I've done a little sort of listed balance sheet showing the type of things that we might get in a typical balance sheet of a business, assets and liabilities. So I've just listed some random things there: vehicles, machinery, stocks or inventory. Two names for the same thing: old-fashioned name stock, new name inventory. Those are the items that we buy to resell to our customers. We've also got cash up there as an asset, and we've also got something called debtors or receivables. Debtors is the old-fashioned name, receivables is the modern name, and it's the name for people who owe us money. So they are assets. People who owe us money are assets. Debtors are assets. People who owe debts to us are our assets, because they're going to pay us in cash, aren't they? Hopefully they'll pay us in cash. Yeah, so they're our assets. And counter to the assets, we've also got the liabilities, the things that we owe. So down there, I've got listed things like creditors or payables. They're the opposite of debtors or receivables. Creditors or payables are the people we owe money to. And the people who we've bought goods off through our trade, we tend to refer to them as trade creditors. We can have other types of creditors. For example, we might owe the taxman money. We might owe money to lenders and so on. Those are creditors, but trade creditors are the people we buy goods and services off for resale to work in our operating business. We tend to refer to them as trade creditors. We've also got an overdraft down there. That would go down as a liability. And lastly, I've got some loans down there as liabilities. So what we do in a balance sheet at the top is we add up all the liabilities and we add up all the assets, and we deduct the liabilities from the assets to get our net assets. And our net assets, as I said before, will always balance back to our shareholders' interest at the bottom of the balance sheet. Let's have a look at a bit more detail on the top. What we do as accountants is we split the assets and the liabilities into long-term and short-term. So we've got long-term assets and short-term assets. We've got long-term liabilities and short-term liabilities. What do I mean by long-term and short-term? Well, a good rule of thumb is this: something is long-term if the business is going to have it for more than a year. When it acquired it, it's going to keep it for more than a year. And a short-term or current liability, short-term or current asset, is something that we're going to have for less than a year. So our assets we split into two categories. The long-term ones we call fixed assets, and they're fixed in the sense that they're going to be around for a long time. Fixed assets also have a modern name, which is non-current assets. A little bit of a mouthful. The phrase that tends to get used in practice still is the old-fashioned phrase fixed assets. These are the long-term ones, the ones we acquire with the intention of keeping them for more than a year. And then we've got the short-term ones, and we call those current assets. So current assets, the ones that are going to change, that are going to disappear in the short term. Things like debtors or receivables, we want to get the money off those customers who haven't yet paid us very, very quickly. So they're short-term assets. Cash is a short-term asset, and so on. Yeah, inventory, stock is a short-term asset. Then we've got the liabilities, and we split the liabilities into current and long-term. And again, the current liabilities, things like overdrafts, things like trade creditors, things that are going to be paid off fairly quickly. And the long-term liabilities, things like long-term bank loans, for example, where when we take the bank loan out, we take it out with the intention of having it for more than a year. So that's how we split our assets and liabilities in the balance sheet. We do them in that order. So fixed assets first, current assets second, then current liabilities third, and then long-term liabilities last at the top half of the balance sheet. Okay, now we're going to focus on the most difficult of all of those assets and liabilities, which are the fixed assets. The fixed assets are the most difficult because with a fixed asset, in general, those fixed assets will lose value over the period that we keep them. We say that fixed assets have useful lives. In other words, let's have a look at some of those fixed assets. For example, on the pictures there, we've got a van. A van, we might buy it, and we might know that because of the usage we put the van to, it's going to last us 3 years. And by the end of 3 years, it will be worth nothing. So when we buy it, we know it's going to last us 3 years. Its useful life is 3 years to us. To another business, it might last them 5 years because they've got less usage per year on it. But to us, it's going to last 3 years. So its useful life is 3 years. And we would also say its value depreciates from whatever we bought it for right down to zero over a period of 3 years. We say that that fixed asset depreciates. Same thing with computer. Computers might have a 2-year life, a 3-year life, a 4-year life. Depends how we use them in our business. And again, the computer's value will depreciate over its lifetime. Same thing with machines, and actually same thing with buildings. Accountants strangely do say that buildings depreciate. The one exception, or the one main exception to this rule, is that accountants say that the land that the building sits on doesn't depreciate. So accountants do something a bit complex with buildings and land. They take a building, they look at what that building cost, and then they separate out the cost of the actual bricks and mortar, the building, and the value of the land. And they depreciate the value of the building over its useful life, but they never depreciate the value of the land. Let's forget about land and buildings for now and focus on the easier stuff, things like vans, computers, and machinery. And let's see how the depreciation works with a simple example. Okay, so look at this one. Company buys a machine which is going to last us 5 years because it's going to produce a product, and we think that product's going to have a 5-year life. So when we buy the machine, it costs us £500,000, 500,000. It's got a 5-year life. When we finished with the machine, we estimate that it's going to be worth nothing. So it reduces in value from 500,000 at the start to zero at the end. So what we need to do is we need to reflect that. Every year we produce a balance sheet, and every year the value of this fixed asset is going to reduce. Okay, so click on to the next slide, and you can see there the 500,000. If we split its value evenly over 5 years, it loses £1,000 worth of value every year. Now, hang on, you're thinking, that's not very realistic, because we know in practice, for example, that if we buy a car, then the car's going to lose more money in the first year than it loses in the second and loses in the third. Yeah, that's true. That's very, very true. But that's only really important to you if you intend to sell that vehicle. Whereas in business, when we buy a machine like this, our intention, remember, is to keep it forever until the end of its life here. We intend to keep it for the next 5 years. So we're not really interested each year in looking at what the resale value is, what the market value is of the machine. All we're interested in doing is showing its value reducing evenly over the period we've got it. And this is also very important for the profit and loss account, because as its value reduces, the reduction in value we charge as a cost in the profit and loss account. We call that our depreciation charge. So each year we'll show the fall in value as a cost in the profit and loss account. The fall in value is the cost of using the machine. So this is another good example of that accruals principle we saw in the last video. We don't put the full cost of the machine into the profit and loss account on the day we buy it. We spread the cost evenly over the useful life of the machine, £100,000 each year in the profit and loss account. Okay, let's have a look at what figures would go in the profit and loss account. Now, we've got the machine for 5 years, but I've just done the first 3 years in the example. Maybe because my slide wasn't wide enough, I can't remember, but I've only done the first 3 years. Okay. So in the profit and loss account, we will have a depreciation cost, a depreciation expense of 100,000 in year 1, 100,000 year 2, 100,000 year 3, and so on for year 4 and year 5 as well. And in the balance sheet, what you'll see is at the beginning of its life, when we buy it on day 1, the machine will have a value of 500,000. But by the end of year 1, it will have gone down by 100,000. And by the end of year 2, it will have gone down by another 100,000 to 300,000. And by the end of year 3, it will have gone down to 200,000. And by the end of year 4 to 100,000. And by the end of year 5 to 0. So we've spread the cost through the profit and loss account. And we've also reflected the fall in value in our balance sheet. So that's how we deal with depreciation. That's what depreciation is. It's just the spreading of the cost of a fixed asset through the profit and loss account. Okay, basic depreciation. You can see the interaction of the P&L and the balance sheet again here in this example, that fall in value is shown and it's reflected through the profit and loss account systematically over the asset's life. Okay, so that's the basics of fixed assets and depreciation. But I don't know if you've ever come across these things. All of the examples on the slide, all the pictures I showed you were examples of what we would call tangible fixed assets. A tangible fixed asset is something you can touch. You can touch it, you can feel it, you know it's there, you can see it physically in front of you. Yeah. But we also have intangible fixed assets, fixed assets that you can't touch. So these, if you look on the slide, might be things like a license to produce a product. Maybe there's this research company that have created this fantastic product. They don't want to produce it themselves. They maybe don't have the factory space. We've decided to buy a license off them so we can produce exclusively over, let's say, a 3-year period. We might have paid them £1 million to do this over a 3-year period. And that license is a valuable asset because it will allow us to produce fantastic profits over that 3-year period. So what we will do with the cost of the license is we'll put it in our balance sheet as a fixed asset, but an intangible fixed asset. And then we'll do the same thing we do with the tangible ones. We'll spread the cost evenly over the life of that fixed asset. And the only difference is a terminology difference. We don't call these tangible fixed assets. We call them intangible. And we don't call the spreading, the charge, depreciation. We have another name, which is on the slide there. We call it amortization. Amortization. It's exactly the same process as we do with a tangible asset, putting the amortization charge in the profit and loss account. We've just got a different name. Let's have a look at an example. And I've used in the example a franchise. So a franchise is when you buy the right to trade using somebody else's brand name and using somebody else's branding, and you may also acquire an exclusive territory within which to sell those goods or services. So we've bought this franchise, and if you look at the example, we've paid £200,000 for the franchise. Now, what did we get for our 200,000? Well, we got £80,000 worth of actual tangible fixed assets. We also got £20,000 worth of stock that we're going to start the business with, that we're going to sell in this franchise. And the other 100,000 was paid as a franchise license fee. And that is just as valuable, if not more so, than the shop fixtures and fittings and the stock, because that's the thing that's going to give us exclusivity. That's the thing that's going to give us the right to use all the branding and the marketing of the company that owns the franchise. That's massively valuable to us. And this franchise lasts for 5 years. So what we do is we take the franchise license of 100,000 and we put it in our balance sheet as an intangible fixed asset. And then we spread the cost over the 5 years. So we would be charging £20,000 of amortization every year in the profit and loss account and reducing that 100,000 by 20,000 year on year. With the shop fixtures and fittings, we do the same process. This time we're putting 80,000 in our balance sheet to start with, and then spreading it over the 5 years at £16,000 a year. The stock, by the way, would go in our balance sheet, but it's stock. It doesn't get amortized or depreciated. It just stays there until it gets sold to one of our customers. So that's how we deal with intangibles. Bits and pieces of terminology there. We've learned about fixed assets. We've learned about tangibles, ones you can touch, intangibles, ones you can't touch. The ones you can touch, they get depreciated over their useful lives. The ones you can't touch, the intangibles, they get amortized over their useful lives. Lots of bits of terminology, but very, very similar process between the tangibles and the intangibles. Okay, there's a balance sheet format. That's what one looks like. If you were presenting a balance sheet and you were showing it to your shareholders, the ones that you actually have to file at Companies House would look very, very similar to that. It might be called a balance sheet. It might also be called a statement of financial position. Remember, it's got more than one name. You can use either name in the UK. In that balance sheet, you've got fixed assets at the top. Remember, they might sometimes be called non-current assets. You can use either name. Then you've got your current assets and your current liabilities. In that pro forma I've shown you there, I've just put the current assets and liabilities slightly indented, just to keep it clean, just so it's easier to view. And I've actually netted off the current assets and current liabilities, so you can see the net of the current assets less the current liabilities there. And then I've got the long-term liabilities, and that gives me my net assets at the top. And then at the bottom, I've got the same net figure, and that's our shareholders' funds. Our shareholders have their original share capital they put in and the retained, the accumulated profit to date, and that balances to the net assets at the top. Now, before I leave that, there is one little thing which I'm sure you've noticed on there, and that's this use of brackets. And this is another strange thing that accountants do that, you know, I'm very used to because I've seen it since the day I started in accounting. But if you're not an accountant, it does look odd. And that is that we put negative figures in brackets. Now, not all accountants do this. Not all businesses do this. Many businesses use minus signs, but a lot of businesses still put negative figures in brackets. So you can see at the top there that the liabilities, the current liabilities and the long-term liabilities are in brackets because they're negative figures at the top. They're deducted from the assets. So they're just a little bit of a way that we present things as accountants. Okay, let's move to the questions at the end of this. 2 questions for you as always. Again, you might want to stop the video while you have a go at doing them yourselves. So you might want to stop me now. Let's have a look at them. The first one, what is a fixed asset? Some strange answers there, but the correct one is number 3. It's an asset that the business will own for more than a year. Okay, that's what a fixed asset is. The second question, which of the following gives the best summary of what a balance sheet is? And the best summary is answer 3, a statement of the business's assets and liabilities and the amount of the owner's investment in the business. Now, there is another answer there, which I just want to pick up on as well, which is answer 2 to question 2. A balance sheet is a statement showing the market value of the business. Now, I've put that in there because a lot of people mistakenly think that that's what a balance sheet does. A balance sheet does not do that. I mean, you're already aware, aren't you, that the fixed assets, for example, the figure we show in the balance sheet isn't the market value of the fixed assets. It's just that figure that shows how the fixed assets fall in value over their useful life. So The balance sheet, you already hopefully have got an inkling that the balance sheet can't show you the market value of the business, because the market value of the business is basically whatever someone will pay for it. And someone will pay, even if you did value the assets at their market value, and the law does allow you to do that if you want, it still wouldn't necessarily show you the market value, because a purchaser might be able to, might be willing to buy the business for even more money than that value, because it has strategic advantage to them. So a balance sheet does not show you the market value of the business. Anyway, on that note, I'm going to finish this video number 3 in our series of finance for non-finance people. I'm Steve from Clearly Training, and I'll see you on the next video. Thank you. Bye-bye.